Hi guys, welcome to today's video. I wanted to go over a book I read a long time ago, back in high school when I first read this book. It's called Rich Dad, Poor Dad, and it's by Robert Kiyosaki. I'm gonna go over my take on it. I read this book a few times, but I took some notes on the last time I read this book, and I just wanted to share my takeaways from this book with you guys. And maybe I think this is a book that will help you, especially if you're a beginner, just to get in the right mindset of being an entrepreneur and understanding that journey and just some of the things that it takes to really be successful. So I'm going to share my screen and share my notes, and let's dive into it. Okay, so I got my screen here and my notes here. Share with you guys so we can kind of walk through this. It's about 7 pages worth of notes that I took when I read this book. Really, I wanted to before we get started, just talking about the Rich Dad Poor Dad. Basically, just to quickly summarize, the rich dad was the father of one of his friends who was a basically an entrepreneur, like business owner, real estate investor, and then the poor dad he refers it to as his own father, who he says has a PhD, was pretty much a teacher, professor. But anyways, he was basically comparing the two different mindsets of a entrepreneur and versus someone who just who's pretty much an employee. But breaking it down, let's dig into the notes, and this is gonna be my takeaway of this book. So understanding first a liability versus an asset. So liabilities. What are liabilities? Liabilities are basically things that take money from you. This could be a personal home, a car, just credit cards, things that basically you spend money on and you usually don't get anything back in return. And so you have to understand that okay, liabilities are basically not good. Assets are things that make money for you. So you can think of this as being a rental property. It could be stocks that pay dividend or having a business. Just understanding that assets are good, and the reason why you want to understand that is because assets make money for you, and so obviously when you make money, that's good. And what can you do with that money? Well, obviously, not so obviously to some people, but with the money you make, you want to get more assets. So pretty much reinvest. Understanding things like investment means different things to people. This could be an education, family, stocks, shares, real estate, insurance, etc. These things can be broken down into more than one categories. So stocks could be mutual funds, bonds. Real estate can be multifamily, commercial, single family. Just kind of understand that there's each category can be broken down to different sections. Being aware of pros and cons of each investment. Stocks are easier to buy and sell, but you can't control the value. So meaning, whoever the company elects as a CEO or the board members, you can't really control the company. It's just something you buy, you hold, you can sell. It's more, they call it as being more liquid. But of course, again, just letting as their take is Robert Kiyosaki's take is that you just can't really control it, the value. Real estate, it's harder to buy and sell. I mean, that makes sense, but in a way, you do have more control over it. Not always, but again, you do have some control. You can try to increase the value with renovation. Try to increase the rent. Of course, there are some things you gotta pay attention to, which is like the market. You can't just charge above market rent, and nobody's gonna want to pay that if you're charging more rent than the other properties that are available. Going to college does not guarantee a job, and you may have student loan debt, but typically will have a higher paying job, so potentially making more money to buy assets. And learn how to learn how to build and obtain businesses. Again, using the use the business to buy assets. Just thinking about the cash flow when it comes in. You reinvest it, buy more assets, or grow the business. Learn about tax laws. Be familiar how businesses are taxed. And one thing that a lot of people don't understand sometimes is that the rich make the laws. And you may be thinking, what the heck does that mean? Well, all that means is that the rich people, they pretty much pay lobbyists or politicians. I mean, they just donate to the politicians or, just things like that. And somehow that's legal. And so when they do that, the businesses are able to have influence. Businesses get much more tax break versus a paycheck. So a business owner, they can write off things like the vehicle, they can write off the utilities, they can write off just so many things. They get tax breaks for hiring employees or reinvesting in the community. There's just so much that can happen. But just understanding that businesses get more tax breaks versus someone who just works and gets a paycheck. Because if you just work and get a paycheck, you get a W-2. You can't just write off you can't write off anything really. You can't write off your utilities, your car, just etc. So just keep that in mind. Don't become addicted to a paycheck. So this is often a trap for people who have a W-2. When you get that paycheck, you just kind of get hooked on it, and you're trading your time for money. So you're just limiting yourself to being comfortable and not ever really wanting to strive for more, other than just trying to get a raise or maybe trying to move up in the company. But that's not always possible. So the main thing here is that the rich do not work for money; they work to obtain assets. So you're thinking, okay, assets. Think, all right, things that make more money, things that generate cash flow. So what do the rich do? They get assets, and then with the money from the assets, buy more assets. So if they buy rental property, get more rental property. You buy a business, grow the business, or get more businesses, etc. Assets make money for you, so it's just understand this will eventually replace your job, your paycheck. In the beginning, it makes sense that you maybe go to school or you have a job, and you start this way, but you have to understand this is be like your stepping stone to get to buy the assets, and eventually the assets will replace your job, your paycheck. So first step to becoming rich, you have to change your mindset and perspective. You can't just think like, oh, rich people are bad or evil. The majority of people who are successful, they usually earned it. They work hard for it. There are a few people who are born into rich, but just understand that you can work and get there, but it takes knowledge. It takes the right mindset to get there. So keep in mind, whatever you believe in, it becomes true to you. If you believe you will never be rich, well, you probably will never be rich. If you believe you will be rich, then yeah, you may become rich. The mind is very powerful. It controls your outlook on life, and so that positive and confident in yourself in your life will go a long way. Never say I cannot afford it. Ask how I can afford it. Saying never or saying I don't have time or I can't do it, that self-doubt, it's going to close your mind, and this makes you not think. If you're not thinking, then you're pretty much not going to change your life. If you pretty much don't ever want to change or keep a closed mind, I mean, you can't expect a different result. Saying how I can afford it, this opens your mind. It makes you think. You can being creative, being and thinking. It opens up your mind. It makes you see opportunities. It just lets you see the doors that are available for you. All right. So understand that nobody is an expert on every single investment. People like what they are good at or what has worked for them. So, example, people who do on stocks or invest in stocks, and vice versa for people who do in real estate or business, etc. Everybody's got their own, it's called a niche or a niche. Everybody has their own thing that they're comfortable with and what they're knowledgeable about, and that's perfectly fine. Being open-minded and being able to see, understand each perspective. So each investment will have its pros and cons. See what fits your style. Know where you want to be, and then making a plan how to get there. So reverse engineer it. So just some examples is, hey, if you're thinking I want $5,000 per month in cash flow. Well, how can you do that? Just a quick example is, okay, maybe you can get 5 houses or units that rents $1,000 each month, and you're thinking, okay, well, what is that going to take? Well, depending on how you go about it, if you're thinking, okay, I'm just going to buy with 20% down. Well, that means each house will need 20% down payment. Of course, again, in one of my other videos, I could talk about being creative with this. If you you could do less money down if you live in the property or one of the units, depending on how you work on this. Work and save up to get the down payment, or buy a house that needs work, then fix it up, rent it out, do a cash out refi, pull out the money, back out, and repeat. This is the BRR method. All right. Other method here is having enough stock paying dividends to amount to, I don't know, example, $10,000 a month. Well, in this case, you just keep buying the stocks, let the dividends reinvest itself to grow. It takes long and takes patience, but you have to pick the stocks you like based on your own research. Or you just do something simple as invest in the S&P 500, something like the VO, which is something that I do on the side as well. A business that runs itself and makes you $10,000 monthly, It could be like starting at Papa John's or Chick-fil-A. This is just some examples. Getting at Chick-fil-A, it's possible, but it's really hard. They're very picky on that. You can do more research into that franchise if you're interested in the restaurant industry. So this is also important, is knowing the vocabulary of your investment. So some examples below. If you want to get started in real estate, know what a tenant is, know what mortgage is, refinance, LTV, loan to value, amortization, balloon payment, interest rate, all these terminology, ROI, return on investment, COC, cash on cash, return. Understanding these terms is very important. So, if whatever you decide to invest in, know the lingo, the language. Same can be said for stocks. What is a dividend? What's a 401k, Roth IRA, pension, S&P 500, things like what are capital gains tax, bond, inverted yield curve. You need to kind of understand these terms. If you don't know, take the time to look them up and be familiar with what they mean. It goes a long way. Just educating yourself goes a long way. Some things to think about is know your plan for when you get old. So it's very hard for young people to understand because, not old yet. So when you're not old yet, you're still inexperienced, you're still learning, and sometimes you're not even worried about the future. You still think that you may be invincible or something. So you have to think about, okay, what if you are sick, you need medical care? This will happen when you get older. It's just part of life. Think about who would take care of you when at that time. You need a plan for this, or you live at home or a nursing home, or will you stay with your kids? But you don't want to be a burden to your kids either. So just think about this. Determine your will, plan how you'll be leaving things behind. Do you have life insurance? Any debt that needs to be taken care of? Again, you don't want to saddle your family with any of your liabilities. Following a plan to become rich is boring. This is why many people stop following the plan and do not become rich. It's repetitive. It's the grind. It's part of the grind. Even when owning a business and running that, you got to show up. First one in, last one out, and that's the grind there. But after a while, it will pay off. Well, usually, but again, it depends. It just depends. So real estate is like playing the game of Monopoly. It gets repetitive. Buying a home, trying to go for a hotel, and you just repeat. And so real estate is like a game of Monopoly. Stocks, again, builds wealth over time. It can be very slow. You're thinking long term, 25, 30 years. Again, if you were to get into stocks, for me, my take is just get into something like that trends the S&P 500. Average 8 to 10% or even more. Again, look at all this information. It's very interesting. Well, let me just pull it real quick right here. All right, so VOO is the let's see here, return rate. VOO is something that's under it's a ETF that's offered by Vanguard, and just looking at the average return in the last 30 years, the Vanguard S&P ETF obtained around a 10% or 10.3% compound annual return. So just understanding that, hey, this is something that tracks the S&P 500, and S&P 500 is you can look at as being the top 500 companies in the U.S. That's I believe it's based on market. It's based on 3 factors, but it's usually the largest companies in the U.S. So if the companies don't perform well or they fall out of being in the top 500, then they get replaced by another. Okay. Again, take the time to look it up and just kind of read it on when you have some time. All right, so note here, don't fall for get rich quick stuff. Be careful about making quick bucks. So this could distract you from your plan. So I'm going to refer this as the crypto stuff. That's just like, that's just junk. There's so many crypto, but I always say, if you're going to invest in crypto, I'll refer that as a get rich quick, but I don't recommend that. Unless it's something that's been around and proven. So I would say really the only one proven crypto, or I don't even call it crypto anymore, but the only proven one is Bitcoin. Again, Bitcoin has its own ETF recently approved, and it's under Fidelity, BlackRock, all these legit firms. So take the time to look that up when you have time. But again, just being careful. Don't fall for the get rich quick. An example could be, in this case, an example here. If you bought a stock at $5, you sold it for $30. It's a good win, but this is usually something that you can't repeat over and over again. Same can be said, for me, it's crypto. You may have made some money at one point, but it's just to keep this going and repeat over and over again. It's really hard. It's not like day trading, it's hard. So be disciplined and follow your plan. So the plan you choose is up to you. See which one fits you. Again, it's good to respect people's plan, opinion. If you can look for a mentor or see what other or look for a mentor or see what other successful people have done. I mean, if you find a role model, a mentor, that's again, I always say this in my course, that it's a shortcut. Follow somebody that's done or that's follow someone that's done what you want to do or is doing what you want to do, and I mean, follow them, and learn from them. Which plan is right for you? This depends on your risk, how much work you want to put in, how fast you want to become rich, wealthy. It determines what's more important to you. Is being secure and comfortable good, or being rich? You have to kind of understand your risk tolerance. So buying stocks and holding for the long term, it's easier. It takes again. I'm referring in this case to like the S&P 500. It's easier, takes long. It's very simple. Not much risk because the investments being slow. You can add money slowly. No credit needed, etc. This is good if you want to be secure and comfortable. Again, with the VO that I just showed with the ETF with that 10% return. I mean that's really good. It takes time, but over time, that compound interest, I mean, it adds up if you're giving over, 20, 30 years. All right. So working at a job, try to get promoted, gain raises, have health insurance. It's safe and comfortable, but again, it depends on your risk tolerance. If stocks go down, you don't owe banks money. So if you have real estate, if the real estate value goes down, I mean, you're still gonna owe the bank money, so it's kind of depending on that. That's the risk tolerance right there. With the stocks, you can automatically have money invested, so it just helps you stay on track. It's just called reinvesting the dividends. So when you get paid, just have it by itself. So second choice here, buying real estate. It's harder. It takes a lot of work and research, and you need a team when you get involved in real estate. If it's a realtor or a broker, a person who help you find deals or close deals, a lender or bank, a lawyer, property manager, and a contractor. Contractor is the person who helps you renovate that property. You gotta research the demographics of the area. What's the population look like? Is it growing, decreasing? The age group. Just kind of know who you're catering to. You want to avoid the ghetto or very high crime area. You need good credit or income to be proof of the loans. You're making your money using debt. Of course, this can be risky if you over leverage. Over leverage is basically just taking out too much money, and if things get underwater or things go wrong, you can't pay it back. So yeah, be careful. But this is good if you want to be rich. It can take less time to build the wealth, but of course more risk. If the economy goes bad, your properties can be vacant. You still owe the banks on the loan. Again, it can be risky if you don't have a plan for when things get bad. And remember that time is the most important thing. It is priceless. Rich people measure things in time and not in money. So they spend their money to buy freedom, their time. Keep in mind that investing is not a race, so do not compare yourself to others. Again, everybody's dealt a different hand, so you can't compare yourself to others. Everybody's situation is just totally different. So understanding here, convert your earned income, which is, for example, you have a paycheck. So if you get that paycheck, convert that into some sort of portfolio or passive income. I mean, that's just the clear goal. So rich level of investing. So education. Make sure you know what you're investing in. Don't just again the quick rich get rich quick. Usually you're just gonna, if some people do that, that's just like, I mean, almost like buying a lottery ticket. It's waste of time and waste of money because you're probably not gonna get anything. You're probably gonna lose money. So experience, being able to look at financials of the business investment and see what's going on. Reviewing a balance sheet, a profit and loss, P&L statement or income statement. Have these analyzed by analyzed by a professional. You can teach yourself how to look at this. There's a bunch of other videos on YouTube that will kind of go over this, but basically it's just showing the money a business or real estate. It could be anything, but basically you can just say business. It just shows that how much money a business makes, how much their expenses are, and whether they made money in the end or not. Basically, you get from here, you get to see what is being done right, see if there can be an improvement. Can you cut expenses? Can you increase the income and revenue? You overlays the business financial statement versus your own. So this is just a something for you to think about, comparing the business's financials versus yourself. Know that the investment is safe and will make money. So excess cash, you can take a loss on the investment. High risk, high reward. Again, some of these might be kind of advanced, but just take the time to digest or go back and read it and research on your own. All right, so smart investors will profit along with getting a tax break. So dream, dedicated, drive, data, dollars. All right, going here. The 90-10 idea investor club. So 10% of the investors control basically 90% of the wealth. How to buy assets or create assets without using your own money or buying them. This shows and makes you think how to collect assets with nothing or very little. So example, creating a business, using a loan, inventing an idea, starting a syndication. That just means raising money to invest. Partnerships. Really is just being creative. The thought process is the real asset. Being creative, yeah, that's an asset. You may not believe that, but just being able to see opportunity or finding a way to close deals or finding a way to find deals. When it comes to businesses or real estate or investments. Just a quick example: turning trash into cash, being able to picture a business in a certain area or a certain scenario. Understanding that the rich don't work for money. It's almost like inventing money via obtaining or creating assets. You use the assets to gain more assets. So understand that when you have an asset like a rental property, a business, you can get loans off that business and the asset, and that loan is tax free. So you don't pay any taxes on the loan because again you have to pay back that money, and the interest is a tax write off. And with this loan, the money that you get from that loan, use it to buy more assets, and you just repeat. So buying assets is okay, just better to create them if you can because this is unlimited. Creating an asset, like an example, you have an idea, or if you're just talented, you can create a song, or you're very good at singing, you have a good, some sort of talent. If you're athletic, sometimes that's an asset, and that's pretty amazing. You didn't have to really. Of course, you're either born with that. Not everybody, but some people are just born with some sort of talent and can make money off their talents. Okay, so investor controls. 10 things investors can control. Not always, but sometimes you can control yourself or your thoughts. You can control the income, expense ratios, the asset liability ratios. Yes and no, but it's arguable because if you, unfortunately, if you're not doing well, then maybe you can lay off an employee, or you can cut down on marketing, or really you wouldn't wanting to, but just thinking about that. In general, you can somewhat control your income and expense ratio or your liability and assets. You can control when you buy and when you sell. When it comes to the business or the real estate, you can choose when you want to buy and sell. Taxes, you can somewhat control your taxes. Again, if you work with a CPA, they kind of tell you what your tax liability is. But again, this is more advanced, but just having the idea of that this is something that investors can't control. Brokerage transaction, this is pretty much your deal flow. ETC, entity timing control, basically when you want to set up businesses or organizations, LLCs. Terms and conditions, again, this is something when it comes to like contracts. It could be a contracts with the vendor, contracts with the tenant, contract with the landlord. Yeah, terms and conditions, you could usually negotiate some parts of this, but again, it's up to you. You accept or decline the terms and conditions of that contract. Access to information. This is important because you have access to the internet. There's a great information, and there's terrible information. But good information you usually gonna have to pay for. But be aware that sometimes there are great information that can be accessed for free. Giving it back and philanthropy. Eventually, if you are really successful, you're able to give back to the community or give back to something that you're passionate about. Oh, maybe I missed a deleted one, but anyways, that's just a quick overview of the Rich Dad Poor Dad notes that I've gotten from this book. There's a lot of other things to go over, but this is just my take on it. And of course, I think one important thing that he goes over was the E, the I, the his. Let me see here. Let's see if I can pull it up here. Rich dad, poor dad quadrant. Here we go. So this here is basically the poor dad and rich dad side. So basically, it's broken like E, B, S, I. So he considers. I mean, it can. Some people can take it the wrong way or take it as an insult, but basically, if you're an employee or self-employed, you're basically on a poor dad mindset where you're having to trade your time or labor for money. What you want to do is be on the rich dad side, which you're a business owner or investor. Business owner could be. I mean, he refers it as being a big business, but I mean, I think just being if it's a business where you can hire somebody and take yourself out of that equation, I mean, that's still really good. Investors were basically you just have the money and you're just putting your capital, your money investment into other people or other investments and just having like a return on your money. It's the I is really where you want to be at. I mean, I get that, but it's you got to start off as being an employee first, and then maybe from employee to self-employed. I view it as this: you start out as an employee, then you jump into self-employed, and then you can go on to being maybe more like a investor to business owner, depending on where you are in your life. So employee, that means you just have a job, even your work, you trade your time for money. Eventually, you could either own your own little small business, and then from there you can jump onto being a business owner, where you hire someone to take over your role, or if you just have enough money, you can just start being an investor, where you just buy rental properties, buy other businesses, and go from there. So hopefully this was a informative video of the Rich Dad Poor Dad uh, uh, book by Robert Kiyosaki. He has other books under this. I'll go over it next time. But again, I believe this is a good beginner, a good beginner's book, because a lot of people, growing up in a household, when you come from a poor household, nobody's really talking about assets and liabilities. You just kind of living your life day by day, and you just working a job, and you're just taught to, hey, don't spend too much, save your money, and work hard, and and it's more than that. You have to understand what an asset is, what a liability is. Understand that you can't just work and save money and trade your time for money. Um, your wage won't keep up with inflation, and you have to plan and really work and think outside the box to really, succeed in life and live a good life. All right. Don't forget to like and subscribe, and thanks for watching.